This is Principles of Financial Accounting, and I am Dr. Baldwin. This is the second lecture on Chapter 1. This lecture mostly concerns transaction analysis and financial statements. First, let's briefly review some concepts that you learned in the first lecture on Chapter 1. Here's a breakdown of the equity section of the accounting equation to show the mathematical signs that we talked about before. So at the top half we have the accounting equation, assets equal liabilities plus owner's equity or stockholder's equity. You can just say equities if you like. And then we've broken down that equity section to show you that it has the contributed capital part and the retained earnings part. And the retained earnings part is increased by revenues, decreased by expenses. Those together are income or loss, and it's also decreased by dividends or distributions to the owners. A little reminder, what is accounting? Accounting, in a general sense, is the process of identifying, recording, and communicating information that is relevant, reliable, and comparable. The goal of the accounting process is to provide helpful information to users of financial information. Quality information may help users reach more informed decisions. So this, identifies, records, and communicates. That's what we're focusing on today. Accounting supplies the information decision makers need to make informed choices among alternate uses of scarce resources in the conduct of economic activities. So accounting is the link between decision makers and business activities. So we have to figure out, how do we record those business activities? So not only what is accounting, now we're more looking at how do we do financial accounting? How do we actually record transactions? So the whole next section is about transaction analysis. Let's look at the identification and recording of these business transactions. We're going to go through a bunch of example transactions and analyze them. We can begin by analyzing this transaction where J. Scott invests $20,000. He contributes $20,000 cash to get the business started. First, we have to identify the asset, liability, or equity accounts involved in the transaction. We can see that the cash account will increase by $20,000. That's pretty obvious. The company is now going to have $20,000. And J. Scott, he or she, is going to hold all of the stock that comes from that $20,000. So there's going to be stock distributed to the owner, and the owner in exchange is putting cash into the business. So common stock account increases by $20,000. Let's see how the books of the company will appear after we record this transaction. Look at the purple. Assets equal liabilities plus equity. So there's our accounting equation, and we're going to put some specific accounts in the appropriate sections. So we said that J. Scott invested $20,000 cash to start the business in return for stock. Is our accounting equation in balance? $20,000 on one side, $20,000 on the other side. We got a lot of blanks, so it's sort of easy to do the math right now. So, next transaction. The company purchases general office supplies by paying $1,000 cash. The asset account cash is going to decrease. This is cash outflow, right? It's going to decrease by the $1,000 cash paid. The asset account supplies will increase by $1,000. The cost of the supplies, going back to that historical cost principle mentioned in the previous lecture. So we're going to record that asset at what it cost. In this transaction, we're giving up one asset, cash, and receiving another asset, supplies. So let's see how this affects the books. We purchase supplies paying $1,000 on $1,000 cash. We can see the decrease in cash, and we can see the increase in supplies. Note that the decrease in cash, we don't put a minus sign in front of it. In accounting, a decrease is shown by parentheses. That makes that a negative number. Notice that the total assets is still equal to total liabilities and equities. Note that there is no change in the liabilities plus equity section of our books, and that the total assets is equal to the total liabilities plus equities. In this case, we still have $20,000 on each side. Let's do another transaction. This transaction is similar to the last one we recorded. Here we purchase equipment by paying $15,000 cash. The asset account cash will decrease by $15,000. The asset account equipment will increase by $15,000. Once again, we're exchanging one asset for another. Can you predict what the books will look like after we record this transaction? I bet you can. Bet you're getting the hang of this. So what happens? Cash goes out. Cash is reduced by $15,000 and equipment is increased by $15,000. The balance in our cash account is now $4,000. We've spent a lot of cash. We have a current balance in supplies of $1,000 and in equipment of $15,000. Those three assets together still total $20,000. And of course, our liabilities and equities haven't changed since the first transaction. They still total $20,000. So we still have a balanced accounting equation. Let's try another transaction. In this transaction, the company purchases supplies of $200 and equipment of $1,000 on account. So we're buying two things at one time and we're doing it on account, meaning we're going to pay for it later, right? Probably within 30 days or something, whatever our agreement is. We're not paying cash. We're going to pay off the account at some point in the future. The asset account supplies increases by the $200. That's the cost of the supplies we've bought. The asset account equipment increases by $1,000. In this transaction, no cash has changed hands, but we have to recognize the debt that we have to pay, the liability. This liability is called accounts payable. That's sort of the simplest liability you can have, something you're going to pay in the future in the short term. It increases by $1,200, by the whole amount of those two together. Let's see what our books look like now. You can see the balance in the cash, supplies, and equipment accounts. The total in the asset side of the equation is now $21,200. We acquired the assets without paying cash, right? It's like you use a credit card to purchase gas for your car. You get an asset, gas, and you incur an account payable to the credit card company. In this case, they bought it on account. The balance in the liabilities account is now $1,200. So we owe somebody $1,200 for what we just bought. And the common stock account balance is still $20,000. But our total of assets has changed, and our total of liabilities plus equities has changed, but they're still equal. The accounting equation is still in balance. Remember, it's always going to balance. Always, always, always. Here's another transaction. We borrowed $4,000 from First American Bank. All right, so we took out a loan from First American Bank. A loan is a liability. It's going to be recorded as a note. Why is it called a note? Because normally when you have a loan, you sign a piece of paper, you write your signature on it, so it's called a note payable or notes payable. So what happens? The asset account cash is increased by $4,000 and the liability account notes payable is increased by $4,000. The asset side of the equation now has a balance of $25,200. The liabilities plus equity side of the equation has the same balance. Our books are still in balance. That's our fifth transaction. We're cooking now. So here's a sort of summary of where we are. The balances so far, just taking them off, basically off the bottom, so we can have some more room to do some more transactions. And of course, the accounting equation, the balance sheet, is still in balance. There's no new transaction on the slide. We're just sort of taking stock. Okay? Now, let's look at transactions involving revenues, expenses, and dividends. Everything we've done so far has either been, we started out with a common stock and cash and some other assets. We've done a bunch of assets and some liabilities, but we haven't done anything with revenues, expenses, and dividends. So we're going to do some transactions that affect those accounts in the next few slides. The company rendered consulting services to a customer and received $3,000 cash in full payment. The asset account cash will increase by $3,000. The equity account revenues will also increase by the same amount, $3,000. Let's look at our expanded book balances. So we're going to put this transaction, this is transaction number 6. We had 5 before, so we just sort of summarized. We're adding this transaction. You can see that our cash account increases by $3,000 to a current balance of $11,000. Total assets now amount to $28,200. The revenue account also increased by $3,000. Recall that from our expanded accounting equation, revenues increase equity and expenses decrease equity. The total of our liabilities plus equity is now $28,200. So we're showing an increase over here in equity in a revenue column. Okay? Let's try another one. The company paid salaries of $800 to its employees. We paid them in cash. The accounts involved are cash and an expense account. We paid $800. The asset account, cash, decreases by that $800. The equity account, salaries expense, increases by $800. An increase in an expense account will decrease total equity. So it's the opposite effect of a revenue we had in the previous transaction. Do you think you can get this transaction recorded properly in our books? What are we going to do? We're going to show the decrease in the cash account. Is that what you did? Did you write down a decrease in the cash account? Did you remember to show the increase in expenses as a decrease in total equity? Right? That's the tricky part to remember. Our expanded accounting equation is getting to look more and more complicated, but don't worry about it. Practice is going to help you fully understand the recording of all of these transactions and similar ones. We're sort of doing this in sort of a simple way first so you can see what's going to happen. Our books are still in balance, aren't they? We have $27,400 in assets and we have $27,400 in liabilities plus equities. We've got another transaction here. The board of directors decided to pay a total cash dividend of $500. The company's cash account decreased by $500. The equity account, dividends, increased by $500. Once again, refer back to that expanded accounting equation. It's about slide 3 or so in this set of slides, and you will see that the dividends decrease total equity. They don't have any effect on income like expenses do, but they decrease total equity. So what do we do here? Did you get this transaction recorded properly? Can you think it through? So here's our cash going out, right? Negative 500. It's in parentheses. That's an outflow or a decrease. The asset accounts decreased by 500. Excuse me, the asset account cash decreased by $500, and the equity account dividends increased by $500. Now, it sounds funny. You got a decrease on the screen, but I'm saying increase. The account increased, but what do dividends do to equity? Like expenses, they decrease equity. So we have to show it decreasing equity. Look at our balances. They're less than they were before. The asset side is $26,900, and the liabilities plus equity side is $26,900. Now, we're still in balance. Let's use all of this information that we've developed to this point and all of these account balances you see here, and let's prepare our basic accounting reports. There are 4 fundamental financial statements used in accounting. They were mentioned in the previous lecture. The income statement shows our revenues and expenses. It's created first. The statement of owner's equity shows the change in the owner's equity during the current period. You also may see a statement of retained earnings, which is just showing you a subset of that. The balance sheet, the third statement we can create, is a listing of all the assets, liabilities, and equity account balances. It's just the accounting equation put out in detail. And the fourth statement is the statement of cash flows, which shows where the company got its cash and how it spent its cash. So let's start with the first one, the income statement. So here's our income statement. Net income is defined as the difference between revenues and expenses. If expenses exceed revenues, we've got net loss instead of net income. That's not good, is it? But if revenues exceed expenses, then we have net income. Financial statements always have a 3-line title. Always. It's going to start with a company name, then it's going to name the statement. In this case, it's the income statement. And then it's going to give you either the period covered by the report, which it's going to do for most things, including the income statement. The exception is the balance sheet, which is going to give you just a date, a point in time. In our case, we had total revenues. We just had that one transaction of consulting revenues of $3,000, and we had total expenses of $800. Our only expense was salaries expense. So net income for the month ended December 31, 2007, was $2,200. After completing the income statement, we can prepare the statement of retained earnings. The statement of retained earnings, what do? We start with the balance at the beginning of the period. So what was the balance in retained earnings at the beginning of the period? Of course, it was 0 because the company just started. Then we add the net income. Remember, net income we figured out here on the income statement on the previous slide. So here's our net income. We're adding it. We're subtracting our dividends. Remember, dividends affect retained earnings and affect equity in total, but they don't affect net income. So we subtract them separately, and that gives us retained earnings of $1,700. So during December, we had net income of $2,200. In addition, we had $500 paid out in dividends. So the ending balance in retained earnings is $1,700. After we complete this statement, we can prepare the balance sheet. Now notice that this statement has a heading very similar to the income statement, except it says statement of retained earnings instead of income statement. But when we get to the balance sheet, you'll find that the heading doesn't have for the month ended. It has the date of the end of the month, the point in time where you're showing the balance. So here's Scott Company balance sheet, December 31, 2007. The balance sheet is an inventory of assets, liabilities, and equity at the end of the month. Our total assets are equal to $26,900. We can get that off our notes where we recorded our transactions a few slides back. This includes cash of $9,700, supplies of $1,200, and equipment of $16,000. So there's all that detail, those ending balances in the asset accounts. We also have liabilities, including accounts payable of $1,200, notes payable of $4,000, and that's our total liabilities of $5,200. But then we have to add our equities, right? We don't want to forget our equities. Our equity balance, we've calculated our retained earnings, so we're pulling that right off the statement of retained earnings. Our common stock balance at the end of the period was $20,000. We only had one transaction with that. So our total liabilities and equities added together are $26,900 as well. Those equal our total assets. The total assets must equal the total of liabilities and equities. That's the accounting equation. It's always true, always in balance. Now, let's talk about the fourth statement, the statement of cash flows. We're going to cover this in detail in a later chapter. Notice, however, at the moment that the statement is divided into 3 major sections. The first section is cash flows from operating activities. The second section is cash flows from investing activities. And the third section is cash flows from financing activities. This statement reconciles the ending cash balance of $9,700 to the beginning cash balance. And of course, the beginning cash balance was 0 because this company just started. Okay? So that's all you really know about the statement of cash flows to begin with. That's going to be our least important statement for a while. Now, at the end of each chapter, you'll find a short section devoted to financial statement analysis. We organize financial statement analysis into 4 areas: liquidity and efficiency, solvency, profitability, and market prospects. Don't worry about the 4 areas at the moment. This particular chapter is presenting a profitability measure called return on assets. Return on assets, as I said, is a profitability measure, and it helps us measure the operating efficiency of a company. Return on assets is calculated by dividing net income by average total assets. Sounds a little complicated, doesn't it? But average total assets is usually done with a simple average. Take the beginning balance and the ending balance of total assets, add them together and divide by 2, and that'll give you a simple average. Net income divided by average total assets. That gives you return on assets. When you read the chapter, that was pretty much the last little section that you read, so go back and look at that if it doesn't ring a bell. That's the end, believe it or not, of this lecture video, the second lecture video on Chapter 1. Strive not to be just a success, but rather strive to be of value. Now you're ready to do your homework. Good luck.